Okay. Jump in here. Kind of give me an idea, guys, of how long you've been wanting to buy a home, and have you started the process before, or are you in the beginning stages? Where are you at in the process? Do you want to buy sometime in the next 2 years? Well, a good place to start out, get an idea of how the process works, what all is involved in it. Typically, what we'll do is we're going through broad strokes here tonight to give you kind of an overlay of the overall process of purchasing a home, what's involved in that. And then from there, I like to set up like a 15-minute phone call afterwards, just to talk to you one on one, find out what you're looking to do. That way we can start the game plan. And for a lot of my first time home buyers, you want to start the process early. That way you have some guidance and then you just work on that game plan. So for some people, it can take 60 or 90 days. I've had other clients where it's taken a year and a half to get them in a position to where they're actually ready to buy or even able to buy. So really, you always want to get yourself in that position so that you have the option. It doesn't necessarily mean that you have to purchase, but it's always better to be in that better financial situation. That way you know what your options are and what everything looks like. So we're going to walk through this here. This is a presentation put out by Magic, which is a private mortgage insurance company, but it's a pretty good deck. So we're going to walk through getting ready to buy a home, buying your home, getting your mortgage, closing your home loan, and then being a successful homeowner. So let's jump in here to get ready to buy a home. The first thing is credit. This is a determining factor, and you probably be surprised of what you can actually qualify for a house and still have a lot of things on your credit. You may have some old charge-offs on there, things like that. Those things don't necessarily preclude you from owning a home. So you really have to assess it and look at it. Obviously, the higher the credit score you have, it's going to get you better terms, better interest rates, and give you some more options there. But as always with credit, you want to make sure you don't have a late payment, even if it's a small payment, a $10 payment. If you get a 30-day late payment on one of those, it can drop your score 20, 40 points just off that one late payment. So I always recommend setting up auto pay on any credit cards you have, and then you want to try to keep your balances low. So you can keep it at 30% of what your available limit is, or 10%, you're looking good. And they go off percentage. So if you have a $9,000 balance on a $10,000 credit limit, it's just like having a $900 balance on a $1,000 credit limit. So they're both 90% usage. The difference is if you have smaller limits, it's a lot easier to pay down those cards quickly and get a boost in your score. So there's different tricks we can do to get you on that pathway if you need help with credit and get you on the right road. Saving and budgeting is a big thing on it too. Right now, we're in a situation where there's low inventory. So there's not as many houses out. There's more competition for those houses. So it's really keeping the price of homes higher. If you're hoping sometime here in the future that the home prices are just going to drop off or something like that, really it's not going to happen. Homes are going to continue to appreciate. They make a flat line here a little bit, but even this year, where interest rates hit as high as 8% in October, homes appreciated at 5 or 6%. So they're still moving up in value. Every year, that home is going to be more expensive. And always, if you can get into that house sooner and you can afford it, you're going to be better off. You're going to start building equity in that house. Your loan's going to amortize. The home's going to appreciate, and you start gaining equity in net worth by being in that house. You always have options with loans and interest rates and things like that. And we can always get creative with those things. Saving and budgeting, typically on a mortgage, for a first-time home buyer, you're looking at 3.5% down. If you're a veteran, you can get in with 0% down. But you also have closing costs on a mortgage, on a home when you buy a house. So you're going to have title fees, you're going to have escrow fees, notary fees, you're going to have home inspection fees, you're going to pay your first year's homeowner's insurance. So typically you're going to have an additional 3% for closing costs. There's some differences between those two, where typically your down payment has to come from your funds. It's got to be from one of your retirement funds, a bank account. It can be gifted to you from an immediate relative, and you can also use down payment assistance for it. Closing costs, just depending on how the market is, you can negotiate and you can get the seller to cover some of those closing costs. Now, when if interest rates come down another percent, probably we're going to see an inflow of buyers into the marketplace, and things will get very competitive. And your ability to get any seller credit in a market like that is just non-existent. So right now, because interest rates are higher, there are some opportunities out there. It just depends on the property to negotiate for seller credit and get some of those costs covered for you. There's different strategies we can employ just depending on what you're looking to do and then what the market allows at that period of time. When you go to pre-qualify for a mortgage, what we're going to do is we're trying to determine what you can afford basically as a monthly payment. So they qualify you on monthly payment really, and then they work it backwards out to what the purchase price would be based on those interest rates. We're going to do calculations. We're going to look at your income, get accurate income calculations. We're going to look at your credit, how much money you have down, what kind of programs are available for you, and then what other types of debt you have. So when we're looking at debt, we're not necessarily looking at the balance of the debt, but we're looking at the minimum monthly payment. So if you have an installment loan for $10,000 and your payment's $200 a month, and you have an installment loan for $50,000 and your payment's $200 a month, $200 a month is all that we're looking at. So we're determining your qualifying amount based on your debt to income ratio. And basically that looks at all your minimum monthly payments and divides it by your gross income before taxes. And based on that ratio and where your credit score is or how much money you're putting down, that will determine how much of a total purchase price you can afford to have. Typically, to qualify for a mortgage, you're going to want to be employed without any gaps for the last 2 years. Now, these are rules of thumb, so there are exceptions just depending on your situation and circumstances. And then we're going to look at your W-2s for the last 2 years. We're going to look at your pay stubs. If you're salaried or something like that, it makes income very easy. A lot of people are maybe on variable income. If you work multiple jobs, typically you're going to need to be on those jobs for 2 years or have 2 jobs for a period of 2 years. And let's see, we got a couple questions here. Yeah, so with student loans, it depends on the situation. Typically, they're going to assess a certain amount, and it depends on what type of loan you're getting. If your loans are deferred and you're not making payments on it right now, then typically, it's depending on the loan program, they're going to take a 0.5% of that balance and they're going to calculate that as a monthly payment in your debt ratios or a percent. It just depends on which program you're using. If you're using a conventional Fannie Mae or Freddie Mac, they're different. If you're using an FHA loan, those calculations are a little bit different. Now, if you have an income-based payment plan and you're at zero and that's your actual payment plan and the loan isn't deferred, which happens sometimes, then you can get away with using that zero payment. But for most people with student loans, a lot of times they're deferred, which means they're just not making payments on it right now until a certain period of time in the future. And they will do a calculation unless you have something in writing. And it just depends on what your balances are at. A lot of times you can go and you can get what your payment would be in writing. It'll be less money than what that calculation is, or we can use whichever one is less. Student loans are a big thing on there. They don't hit you with a super huge payment on it. So it just depends on where your balances are at on it. If you're a W-2 employee, typically we don't need to see any tax returns or anything like that. This last 2 years of W-2s, a month of pay stubs. That's your typical income documentation that we're gonna work with to make sure we have your income calculated properly. And all these things matter because $10 a month, $20 a month, $50 a month miscalculation can be the difference of $5,000 or $10,000 in purchase price in your home. So when you're actually applying for a mortgage and you're getting these calculations done and determining what you qualify for, you want to make sure that whatever lender you're working with has all the information they need to get you proper figures and things like that. But yeah, so with jobs, as long as you don't have a huge gap there, and by a huge gap, more than 6 months. So you can move from one job to another, If you go from a job that paid you a salary and then you go to a job that's straight commission, that would be a different story. Then you're going to have a work history of the commission income. But yeah, you can change jobs. Typically, when you're in the process, you really don't want to do anything like that. But it's not going to, if you change jobs recently, it's not going to affect your qualifying amount as long as you're on there for a month, usually. So we have a month of pay stubs and you're full time. If you're part time to part time, you're going to want to see a little bit longer history at a new job if you're working just part time, if they're not set hours. And you don't necessarily have to be at 40 hours a week, but if you have a set schedule. So if you work 20 hours a week and that's your scheduled hours and you're guaranteed 20 hours every single week, that's what you work every single week, then we can work with that in a little less time frame. But if you work 18 hours one week, 32 hours another week, 24 hours another week, then typically they're going to want to see a solid year on with that one job, as long as you have a 2-year history there of working in a part-time field like that. So when it comes to buying your home, there's lots of things to consider, especially if you're moving from an apartment to a house. You're going to have more utility costs, your water, trash, your electric bill is typically more expensive on a house as opposed to an apartment complex. So these are things you really want to consider in your budget when you're looking to purchase. I always want to keep those things in mind. And really, who makes up your team for purchasing a home is going to be your loan officer and your real estate agent. In our industry, we all have people we work with often. Real estate transactions, they can go smooth, or sometimes they can get sticky. Some things can pop up in title and escrow, things can pop up with an underwriter, things can pop up with home inspections, different things can pop up throughout the process. So you want to make sure that the realtor and the loan officer you're working with have good communication with each other. They're comfortable working with each other and you're comfortable with them. Always keep that in mind. If you're only available at nights and weekends to talk to someone, you certainly don't want a loan officer that works 9 to 5 at a bank and that's their office hours. It's going to make things difficult. So you want to make sure that you're comfortable with whoever you're working with, comfortable with asking questions, you're getting the answers when you ask them, and that's going to really make the difference between a smooth transaction and pulling your hair out, because it gets hectic when you buy a house. A 30-day period, 30 calendar days go by fast. Home inspections are going on, appraisals are going on. You're dropping deposits off at escrow. There's disclosures to sign from the lending side, from title and escrow side. You're going to have disclosures and contracts with your realtor you're signing. So you want to make sure that you're aware of what's coming up next, so things just move nice and smooth. And then if something does pop up, it's not you're not in a middle of chaos with everything else. You just concentrate on that, find a solution for it, and keep everything on track. So once you are pre-approved, and once you're pre-approved, that's typically your ticket to start shopping. Just because you're pre-approved doesn't mean you have to go out and buy a house right away. Typically, a pre-approval is going to last 90 days. Most pre-approvals, a lot of times, are going to be updated with every offer you make. So if you're pre-approved for 400,000 and you're making an offer at 375, it's very common to reissue a pre-approval at 375 just for negotiating purposes for your realtor and things like that. When you go in, you find a house you like, you're working with the realtor, you make an offer on that house, and that listing agent is going to get with the seller. They're going to go over any offers they have. And then this is when you get into a negotiating period. And there's a couple of negotiating periods throughout the 30-day period. They may counteroffer you. You may be asking for closing costs. They may counteroffer you. There may be multiple offers. When rates were at 3%, people were paying $20,000 cash over what the home was worth just to get an offer accepted. And in some markets, you can negotiate and get $10,000 from the seller to cover closing costs or maybe buy your rate down. So it always depends on the market. So you always want to make sure the people you're working with are full-time people, that they're familiar with the market situation. There's a lot of people, especially on the real estate side, who are licensed, but they're not full-time. It's a part-time thing. Maybe they help out a relative or two during the year, but they're not really familiar with what's going on in the market And the purpose of that realtor is there to make sure that they're advising you, you're getting good advice from them, they're negotiating deals for you, and 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 yeah. So when you go and you make an offer, say you're there's going to be contingencies on there. There's going to be contingencies on there, and what a contingency is, if you get an offer accepted, you're typically going to put maybe a 1% deposit down. That money's going to go to escrow. Escrow is going to hold that money. Escrow is really just a third party. They have no skin in the game. They're not part of the sellers. They're not part of the buyers. They're not part of the lenders. They just basically hold everything and make sure that each party does what they're supposed to do according to the contract. So they make sure that the lender, they get the money from the lender. They make sure that if the buyer is putting down payment down, they make sure that the buyer brings in all the funds that they're supposed to. They make sure that everything gets paid off on the back end. So if you're buying a house with a mortgage on it, escrow is making sure that when that money comes in, that loan is getting paid off. But that money kind of sits there, and there's contingency periods throughout that 30-day process. So you're going to have a period to do inspections and your appraisal. Oftentimes it's a 17-day period. And within that time, you want to make sure that all your home inspections are done, the appraisal's done, if there's any issues with the property. A lot of times there are things that will come up during that period. When you do an appraisal, an appraiser is really just out there to determine what the value is of that house. You know, they're going to, if there's any major health or safety issues on the property, they're going to make sure that it's up to code, but they're not there to inspect the wiring or anything like that. They're really there to determine the value of the property and make sure that it's up to code. That's why with your realtor, you're going to do a home inspection, and that home inspector is going to go through that house with a fine-tooth comb. And from that, just depending on what's on that report, will determine what you're going to do there. So oftentimes there may be a home inspector is going to pick that house apart. It could be little things. It could be a light switch cover. That's not really a big deal if you're buying a house. But if there's a major issue with the water main, or if there's a major issue with something, you want to be aware of that before you buy the house. So you don't want to go in and get a lemon. And there'll be stuff in the middle side, and you're going to get with your realtor, determine what are the important issues on this report, what needs to be addressed. And then you're going to go back and you're going to put in a repair request to the seller. And this kind of opens up a negotiating period there. Where oftentimes the seller will say, we don't want to do these repairs, but we'll give you $1,500 credit and you can handle them on your own after closing. There are different periods there where you're going to renegotiate stuff, just depending on the value of the house. And everything's determined on market conditions. A couple of years ago, when things were 3%, you were making offers with no contingencies. So no appraisal, no nothing. If the appraisal came in short, you were on the hook for it, just to get offers accepted. Always knowing what the market conditions are and being ready to take advantage of things in the market. So you always want to be prepared, because you never know what's going to come up. Last year, Cal HFA came out with a program to give people 20% for down payment and closing costs. So you could buy a $400,000 house with a $300,000 loan and walk in there with no money out of pocket. The people that were prepared, they got it, because the money was gone in 9 days. That's it. 9 days, it was gone. People who waited and then they heard about it and then they wanted to try to get it, it was just too late. The people who were already pre-approved and had all their ducks in a row, those are the people who were able to take advantage of that program. So you always want to be ready. And if you want to buy a house and I don't have the money right now, or you always want to be in a position to where if something like that pops up, because when it pops up, a really good offer like that stuff's gone quick. You know, that you always put your best foot forward on those things. You're going to do the home inspection. This is something you're going to do with your realtor. Oftentimes, the home inspector will go out there. They're going to be out there for several hours. And usually what they'll do is the home inspector will go through there and do the home inspection. The report's pretty detailed. And oftentimes what they're going to do is they're going to have you come out at the tail end of it and for maybe a half an hour there, 20 minutes, half an hour. And that home inspector can walk you through and point out any major issues. It can be hard reading the report to determine, is this a big deal? Is this not a big deal? but you go out there and meet up with the home inspector, and he'll do a walkthrough and point out any major issues that he came across or any concerns on his end. So it gives you a little clearer picture. So, on the mortgage side of things and out-of-pocket costs, you're going to have your down payment, you're going to have your closing costs, and then you're going to have inspection fees. So an appraiser, you're going to pay that appraiser once you go into contract. The appraisal is ordered. You pay that appraiser up front. They won't go out to the house unless they're paid. The home inspectors and things, any inspections you're doing on that side with your realtor, those people, you're going to pay them directly. Other than that, other than inspections like that, everything's handled through title and escrow. When you first go into contract, typically you're going to have 2 or 3 days to go in there and drop off your earnest money deposit, which is oftentimes is about 1% of the purchase price. You can wire that money over to them. You can drop it off there with them, and they're going to hold that money. And basically, that money is, the money's not at risk until it comes contingency time and you remove contingencies. And it's not something that just happens. You have to sign a form. The listing agent has to be on the ball enough to send you those forms and request that you remove contingencies. Sometimes you're ready to close before contingencies are even due off, or you're at the closing table before anything like that's even removed. But if you get into a house where you do these inspections and you find out that there's a major issue there and it's going to be a problem and there's no real way to fix it, and it's something that you definitely don't want to get into, you're able to cancel and cancel that contract and get out of that transaction. Now you get your earnest money deposit back that you left with escrow, but any inspection fees you pay, you're not going to get any of those things back. Those people are out there, they did their job and they were paid for those services. But it's better to pay $500 for something and find out that the house is no good and get out of it than to get into a $300,000 or $400,000 loan and find out 4 or 5 months into the house that there's a $15,000 plumbing issue. And so you always want to make sure you're doing all your inspections and stuff like that. But at closing, you're going to have the balance of anything from that's left over for your down payment and closing costs minus whatever deposit they have. So that deposit's actually part of your down payment or your closing costs, whatever your final cash to close is. It's part of those fees. Talk here about getting your mortgage. So mortgage is a little bit different than paying rent. When you pay rent, you pay at the beginning of the month for the month going forward. For January, you pay rent January 1st. That's for the month of January. When you're in a mortgage, your January 1st payment is for December. So you're paying the month behind you, not in front of you. So each payment's going to have a certain amount that's going towards the principal on the loan, which is paying down the balance. You're going to have the interest on that loan. So for that past month, those 30 days, depending on the balance, however much interest accrued during those 30 days as part of that payment. Typically, you're going to have property taxes and homeowners insurance impounded. And especially if you haven't owned a home before, always advisable to do that, even if you're putting a larger down payment down. Property taxes come twice a year, usually December, April. It's split in 2 payments. And if you're not, if you haven't been a homeowner for a long time, you're not used to making those large payments, you can get yourself in trouble there if you're not real good at budgeting your money and setting it aside. So it's much easier to just include it in your monthly payment, split up over 12 months, and then it's always paid out for you on your behalf, and you never have to worry about that. Same with homeowners insurance. Homeowners insurance is paid once a year, and at closing, part of your closing costs is your first year's homeowners insurance that's paid out through title and escrow. And then they're going to collect whatever if it's $900 a year, they're going to divide that by 12. They're going to collect that each month as part of your payment. And whoever you're making your home payments to, they're going to set that aside in an escrow account. And when those bills come due, they're going to pay it out on your behalf. A house payment is typically going to include principal, interest, property taxes, homeowners insurance, and then mortgage insurance if you're putting less than 20% down. Now, if you got good credit and you're in a conventional loan, there are different options there. with taxes and insurance. I typically, especially if you're a first-time home buyer, I would recommend getting a mortgage. It's going to cost you a little bit more. It's going to cost you a little bit more. But it's going to advise you're going to be in a better situation just including those items always in your payment. Um, Now, if you're putting less than 20% down, you're also going to have mortgage insurance on there. And there's a difference between mortgage insurance and homeowners insurance. Homeowners insurance is typically considered fire insurance. If your house burns down, it's going to cover the replacement cost for that. And then mortgage insurance is what allows you to buy a house with less than 20% down. So the mortgage insurance is basically ensuring that difference there between if you put 3% down, it's ensuring that difference there as opposed to putting 20% down. So if you were to default on a loan with 3% down, it would be a big problem for the lender. By the time eviction or foreclosure went through, the house got back on market, they would lose a ton of money. And in turn, they wouldn't even lend to that to anyone with less than 20% down. When you're in a conventional mortgage, once your balance gets down below 80% of a loan to value, you have 20% equity in that property, you can remove that mortgage insurance. You can remove it a couple of ways. You remove it by refinancing. Just depending on the lender, oftentimes you remove it by having the house reappraised. Once you're in the house for at least 2 years, you can just have it reappraised and get the mortgage insurance off. If you're in there less than 2 years, unless you've actually paid the balance down a loan, you can't get it removed just by the house appreciating. When you're in an FHA loan, that's on there for the life of the loan. So oftentimes, first-time home buyers will use an FHA loan because it's a low down payment loan. They're much more flexible on credit. You can get in with a 580 score, and they'll allow higher debt ratios. Lenders will lend on it because the government is insuring the loan. Should you default, the government's going to cover any differences to make sure that the lender doesn't lose money. So oftentimes, first-time home buyers purchase that house with an FHA loan, and then later on down the road, their credit's getting better and better all the time. Now they have a mortgage under their belt. And once they get to that point where they can get rid of that mortgage insurance, they're going to usually refinance into a conventional loan, eliminate that mortgage insurance, and move on from there. Typically, on a mortgage, you're going to do a fixed rate mortgage. The interest rate's going to stay the same. If you stay in a 30-year mortgage and your interest rate's 6.5%, if you stay on that loan for 30 years, the interest rate's always going to be 6.5%. Now, there are some different types of loans. There's adjustable rate mortgages where there may be a certain term where that's fixed. And then after that, that loan will adjust based on the market. Maybe be in a 5-1 ARM or 7-1 ARM or a 10-1 ARM, where for that first 5 years or 7 years or 10 years, you're going to have a fixed interest rate on that loan. And then when that 5-year mark hits, then every year the rate's going to adjust depending on where the market's at. And there's different indexes they use to determine what your rate's going to be. I've been in the industry for 10 or 12 years now, and the markets really haven't needed anything like an ARM. Now we're in a market now that kind of needs that because we're in a market that kind of needs those kind of products because the interest rates are so high, just to help with the affordability issue. You just got to make sure that you go in where it's going to adjust to, that it's not going to get you in trouble should you use a product like that, and you're not just using it and to get in the door and then it comes as a shock to you. You never want to be in a situation where your payment adjusts and it goes up $500 from one month to the next, and you weren't even aware of that. So 99% of the people out there are going to use a fixed rate mortgage, even in this market where the rates are. There's usually not a huge advantage to using an adjustable rate mortgage. With down payment and stuff like that, it just depends on the loan program and where your credit score is. In an FHA loan, you're going to put 3.5% down. A conventional loan, if you're doing that and you have good credit, as a first-time home buyer, you can put as little as 3% down. So there's different options. And then, just depending on where you're at, there are different down payment assistant options, but you really got to look at it. You got to look at it both ways. So you always got to make sure, hey, what's this loan look like if I come up with 3.5% down? You got to look at the figures that way. What's the loan look like if I use down payment assistance? Because down payment assistance, a lot of times you're going to pay a much higher interest rate. A lot of times they're going to tack those comes with different origination fees. So it, it may seem on the surface like you're getting 3.5% down, but your closing costs just went up $8,000 on the back end. So just depending on what program you're using, what credit score you're at, sometimes it can be the difference to help you get into that house. But oftentimes, friends, family, relatives who can help you get in with gift funds or anything like that. If those are an option, typically it's going to put you in a much better situation with much better interest rates, terms, and stuff like that. But you always want to look at the whole picture and when you're looking at stuff like that. Private mortgage insurance is referred to as PMI. And that basically it's just to ensure that difference between what your down payment is and 20% equity. It allows you to do that. So for the lender, it's like you're putting 20% down. Should you ever default on the loan, there's going to be that cushion there for that lender to be able to resell that house without losing a ton of money. And that's the thing we want to try to keep home ownership affordable to everyone, get as many people into homes as we can. It really is the determining factor, net worth, middle class, the quality of life you're going to live when it comes to retirement years. Home ownership is the difference between struggling and being able to enjoy your life. You think rents will always go up. And typically when you first buy a house, you're going to pay a little bit more for that mortgage payment than what rents are. And that's the trap of it. You're thinking, I don't want to pay extra money. My rent's this. Why would I pay this much more for the same house just to own it? But what happens is every year, every 2 years, that lease is renewed, rents go up, and there comes a point where that rent skyrockets past that house. You're in that house for 10 years and renters are paying $1,000 more a month for an apartment and you're in a 4-bedroom house. And it really keeps that housing stable. And it's also as a piggy bank there. So unforeseen things happen in life and you own a house and you have equity in it. That's an area you can tap. That's a resource you can use. Long term, you want to think long term when it comes to home ownership and look past just the short term because the quality of life is going to be drastically different as a homeowner when you get into your retirement years and things like that. There's a ton of different acts to protect you. I wasn't in the mortgage industry in the financial crisis. I came into it probably, I want to say 2011 as the industry was coming out of that, where they were doing all those loans and they crashed the economy and stuff. And it was crazy back then. Anything went. If you went into a lender, excuse me, it was like going into a used car dealership. They negotiated interest rates like that with you, like people walking back and forth to the manager's desk, and it was crazy back then. There's lots of things to protect you in the market now, and it's just a matter of making sure that you're comfortable with the person you're working with. You have trust in their knowledge. They're making sure that you're getting into the best program. There's really not programs out there that's going to benefit where they can be predatory with it, pushing you into something that's going to make them a ton of more money or something like that. Those things really don't exist. Margins are capped and they're the same across all loan programs. So really it's determining what loan program is going to be best for you. Interest rates are really determined by mortgage-backed securities and secondary markets. And then it's either going to be you're going to pay some to get an interest rate or you're going to get a rebate back. And a rebate back can be used for closing costs and things like that. So that just really depends on what's going on in the market. 6-7 years ago, I could get a client $7,000-8,000 in rebate by taking an interest a point higher. They get $8,000 to cover their closing costs and get into a house, be in there for 6 months and refinance and drop their interest rate down. It was a win for the client. In this market where interest rates are now, usually there's not taking any kind of rate rebates, just not worth it. Your lender should always be able to break down to you what your recoup costs are. And you want to make sure that you're not paying 2 points for interest rates that's a little bit lower than what the going rate today is. May sound attractive to have that lower interest rate, but typically If you look at how much money you save a month and what you're paying up front for that interest rate, it may take 4 or 5 years to break even on it. So you would have to be in that loan for 4 or 5 years before you really start benefiting. And in this market, within 4 or 5 years, rates aren't going to be at 7, 8%. They're going to be at 4 or 5%, 4 to 6%, at a more normalized area. Most people are going to refinance. The average person is only in a loan, is only in a 30-year mortgage for 7 years. So that's the average. So they're either selling, moving up, downsizing, upsizing, or they're refinancing. There's some period of time in there. So you always want to keep those things in consideration when it comes to those things. And a lender should always be able to disclose to you what fees or costs are associated with that rate. This is where you can get into an area where things can get deceptive with different lenders. You go to one lender, they're telling you it's 6.75%. A lender tells you, 5.75%. But they're not telling you that they're charging you 3 points to get that rate. So always, they should be able to break down to you if there's points on a rate, what are the points, and then understand that interest rates are changing constantly, daily. They're just like stocks, like the stock market. They go up, they go down, they're traded. So you always want to compare things apple to apples and just make sure that you're getting, everything disclosed to you, and you're not in the middle of a transaction 20 days into it, and then suddenly you're finding out that you're paying $10,000 in points on a loan or something like that. The mortgage application process is really super easy. Most all lenders, we have online apps. You can do it right from your phone. Typically, you do a mortgage application in less than 5 minutes. And then from there, pay stubs, W-2s, so that we can get an accurate income calculation. It's always important to make sure that income is calculated properly. From your credit report, we're going to pull in any debts you have, any monthly obligations on there. And then based on that, we'll be able to determine what your max qualifying amount is. And then from there, you really want to think about your budget, what you're comfortable with monthly payment wise. Oftentimes, you're going to qualify. A lot of people will qualify for more house than what is even advisable for. Some loans you go 55, 56% of your income before taxes are taken out for your debts. Not advisable to go that high. You want to make sure that you're aware of other costs when you go into a house, electric costs, electricity, utilities, all those things, and upkeep on it, and make sure that you're in a comfortable spot there. And that doesn't mean if you want to get in a house, you may have to make adjustments to your budget to be able to afford it. But a lot of times, if you're preparing beforehand, it's good to get a breakdown of what the house payment would actually be. And a good way to start budgeting and saving is if you're paying $1,800 a month in rent, and the house where you qualify at would be a $2,500 a month payment. You want to be able to put $700 aside into a savings account every month when you pay your rent. And that's going to tell you whether or not you can afford that payment. It's going to do two things. It's going to tell you if you can afford it, and it's also going to save money and put money aside for down payment, closing costs, and things like that. But it's good the earlier you can start preparing for it, the better you can get a feel for your budget. It can also help you save. The last thing you want to do is get caught up in an emotional buy for a house, for a mortgage, and then be house poor, but you're already in a mortgage. If you start adjusting, you get a breakdown of figures of what your payment would be every month, and then putting that difference between what your rent and that payment is aside. And you may find you can put more money than that aside. You may find out that you can only put X amount aside. If you ever have to tap in that money, then you know that you would have an issue in a mortgage that size. That's a good way to do those things. The loan process on our side, we're going to make sure that you're in a good situation when we pre-approve you. We've got our I's dotted, T's crossed. The amount that we pre-approved you for is a solid amount. That way, when you're out shopping, you can shop with confidence. When your realtor is showing your home and making offers on houses, they know that there's not going to be any major issues there. Once you get into the process of contract and you find a house and you make an offer and it's accepted, at that period of time, the loan's going to go through it's going to go through processing. They're going to do verifications of employment. They're going to verify with your employer how long you've been employed there. The employer is going to give figures of what you made each year, make sure everything matches up. It's going to go into underwriting. Underwriting is really a two-step process usually. So you're going to go in there with your initially underwritten, and the underwriter is going to sign off on everything, and they're going to make a list of final items they need to get the final approval on the loan. A lot of times, everything's working together on the backside when you go to buy a house. You title and escrow people doing stuff, title checks, making sure that the house is clear, that no one else can lay claim to it. Your realtor is going to be setting up home inspections and things like that, and negotiating any negotiations during the process with the seller. Your lender is going to be working to get your lender approved. And then, but when we go into underwriting, a lot of times we don't have all the information. We may be missing some items from title and escrow. A lot of times we're not going to have the appraisal report back yet. So these are items that the underwriter is going to say, copy the appraisal report at value. We need these items from title and escrow. They may have questions on your side, but usually we try to address those things beforehand so that when we go in there, it's not going to be an issue. If you have a complex income or something like that, sometimes you're going to be back and forth with underwriters. But if you're self-employed or anything like that, you just want to make sure that you're working with someone who knows how to calculate those types of income. If you make commission, if you're part-time or your income varies, your loan officer who's pre-approving you just need to have confidence that they know how to calculate those incomes. So if you make $100,000 a year and it's salaried, anyone can do that. But if you have a Schedule C and you have a side business, and then you work, and some weeks you work 18 hours, some weeks you work 40 hours, and it varies, and then you get a commission override on it or something like that, or bonuses. You just want to make sure that you have confidence in those more complex income streams, that your loan officer knows what he's doing and calculates it accurately. Because even just being off $100 or $200 a month could be the difference of qualifying and not qualifying at a certain purchase price. So it always matters having your figures tight like that. And on your end, when you're working with someone, you just need to make sure that you got confidence in them, that they know what they're doing, and they'll make sure that you're in the right position to make everything smooth for you. When you get down to the tail end of a loan, you're going to get what's called a closing disclosure. And typically there's actually a wait period before you can sign final loan docs, which is three business days. When your loan's initially disclosed to you, we're working off estimates. So we're estimating title and escrow fees. We're estimating what your homeowner's insurance will be. Typically, your loan's not locked yet, so we don't know what exactly the rate's going to be at when we lock your loan. So by the time we get down towards closing, we have all those things. We have all those figures. Everything's in there tight. And as a lender, we issue to you what's called a closing disclosure. And it's about 4 pages, and it just breaks down all your figures on there. And really the purpose of that, and to give you 3 days, is to make sure that there's not anything missed on there, that everything's accurate on there, that if you have any questions about any of the figures on there, that they're gone through with you, so that when you go to actually sign your loan docs and you close, you've basically gone over all the figures. There's no surprises there at the closing table, and everything is just moved nice and smooth for you. Sometimes you get in a situation where that closing disclosure goes out, and maybe the realtor's negotiated an extra $1,000 seller credit. Lender wasn't aware of it. It's not on the figures. So having those 3 days is crucial to make sure that any items like that may have been negotiated towards the tail end of a transaction are included in there. And that way, when you go to close, everything goes smooth. So typically, when you're at closing, you're going to sign with the notary in person. We do hybrid closings, depending on what loan program you're in. A lot of times you'll be able to docu-sign a certain portion of your closing docs. A closing loan package for a mortgage can be 100 pages. There are certain ones in there that are state federal disclosures that you're allowed to docu-sign now. You don't have to wet sign them all. and then your key things that are being recorded with the county and stuff like that, and are being notarized, you're still going to wet sign those. When it gets down to closing day, you're going to have a figure that your final cash to close, any balance between after your deposits subtracted from what you remaining of the balance that you owe, any seller credits are deducted out of there. You're gonna have a final figure, and when you get down to closing, typically at that time, what you're gonna do is you're gonna wire those funds to escrow. So you're gonna do that, the day before, the day of signing, and then once you sign your loan docs, once escrow's received all the funds, they've received the wired funds from the lender, they've received any balance from you for down payment and closing costs. And once they have all those funds, then they'll send the documents to the county to record. And once it's on record there, then you're officially a homeowner. And typically at that time, you meet out there with your realtor, get your keys and things like that. That's a lot to gobble down there, but I do have a booklet that accompanies this. Would anyone here like me to email that out to them? Yeah, I'll shoot a copy out to everyone who's on here. You guys have any questions or anything like that? Any thought or feedback? Was the information useful for you guys? Yeah, shoot. What do you got there, Ruth? Are you able to?
Okay, yeah, I
Oh,
can.
there we go. All right.
Yeah, thank you. This was great, by the way. Thank you for having it. Okay, you mentioned, of course, everyone needs to feel free, comfortable with who they're working with. Do you have, I have friends that are realtors, but I'm just wondering if there are people that you work with
Yeah,
that you
absolutely.
feel work great together.
Yeah, I do quite a bit of business with several different realtors here in town, and so always I can recommend a realtor for you if that's what. Usually, it's gonna be better for the whole transaction.
Right,
Sometimes you get two people who've never worked together before, and they have different communication styles, or
right.
they don't know each other's shorthand. You know what I mean?
Yeah. All
Um,
right. Okay, it's good to know. Thank you. I have another question.
yeah.
Okay. How much can you buy down the rate? How much?
It depends. You're going to run into issues of high cost mortgage. They'll only allow you to buy down a certain amount. You can't just buy down an unlimited amount. And usually it's somewhere around 3%, but it gets a little complex because they're running off bona fide points. So it goes off of what your qualifying rate is, and then you can only take it down a certain amount. To
Okay, and
actually,
on average, how much?
Mhm.
I'm sorry to interrupt, but
Yeah,
on
maybe
average, how
maybe
much would
two,
it be?
two, two, 2 or 3%, maybe.
Okay, 2 or 3%. And
That's your paying. You can't. That's not bringing the interest rate down 2 or 3%. Those are the points that you're allowed to pay. So I mean,
okay, this is
it could cost you two. It could cost you 2% to get your interest rate down 1 point. So what it costs you is if the interest rate 7%, it may cost you. It just depends on where rates are at that period of time, but it's not a 1 for 1. So you don't pay 1% and get 1% off your mortgage. Are you following me there?
yeah, it sounds like 2% for 1% off, right?
Yeah, it could be
About
something
there.
like that. Yeah, it's not a standard. So it depends on where the loan programs are. Sometimes, and this goes into secondary. This is even above this, far above my head, but sometimes rates get really weird where there'll be a sweet spot. 7.25 may cost you $1,500, and 6.75 may give you a $200 rebate, and it's a lower interest rate. So sometimes
Right.
wacky
Okay.
spots like that on a rate chart just because of the demand on the mortgage-backed securities market in secondary. There's a big demand for that. So it's pulling that rate coupon down at a certain point. As a lender, when we're looking at interest rates, everything's broken almost at the eighth of a point.
Okay.
5.125, 5.25, and it goes all the way up to a certain high spot. Somewhere in there would be a par rate, which is a true par rate would be a zero cost, but most lenders are operating on eighth of a point. So you're either going to be a little bit of a cost or a little bit of a rebate, depending on which way you go. Um,
Right. And it also sounds like, I guess it would be determined at the time of the purchase, right?
yeah.
Yeah.
So
Okay.
uh,
All
every,
right.
right now, there's a lot of volatility in the market. Hopefully, we're starting to see signs that this inflation, they are getting it under control, that it is coming down. And as this inflation starts to come down, these rates will follow. More than anything, when the Fed hikes rates and stuff like that, it's a short-term rate. It's almost an overnight bank-to-bank lending rate. It really affects short-term loans, credit card payments, adjustable rate HELOCs, things that are constantly adjusting. It doesn't necessarily have a huge effect on a long-term loan like a 30-year mortgage. But usually, if the Fed's cutting rates or raising rates, it's because there's an inflation problem. And the inflation is what's really taking these interest rates up. It's hard to lend someone money at 4% when inflation's at 8%. You know what I mean? They're losing 4%.
And I
So
also heard that later this year they're going to get tighter with their restrictions and in lending. I don't know if you heard that.
they're tightening down. They're always making adjustments. So you wait and see what adjustments they're going to make. But right now, the housing market, the mortgage industry, they're on solid grounds. We're at decades low default rates. People have,
Hmm.
I think, $15 trillion worth of equity, homeowners in America
Right.
have about $15 trillion of equity in their homes. So they have tons of equity and in a much healthier spot. The loans that are issued today aren't like they were 10 or 15 years ago, where it was just stated income and make something up and you got a loan. They are strict on it, and lenders get strict on certain things. A lot of people will, instead of selling their house and moving up, they'll rent out the house that they've been living in, keep it as a rental, and then move into a new house. So those departing residents and stuff like that, certainly I know a lot of lenders are cracking down on fraud in those areas because people will say that they're going to rent out their house and the house they're buying is going to be their residence so that they can get into it for 5% down. Uh,
Oh,
and then they're renting out the house that they're buying. Instances where a lender finds out that someone did that and they called the note due right then.
oh,
You know,
wow.
so
Yeah.
you either got to refinance or you got to pay off the mortgage, sell the house or refinance it. We want our money.
They want you to fix it right away.
And
Yeah.
we'll never do, but yeah, we'll never lend you again. So,
Wow. Thank you
but
for that. I have
yeah,
one more question because I do have a relative that's also looking to buy, and she was interested in some kind of like first time buyer program.
yeah.
And you mentioned a lot of times when are there certain times of the year or how can she look into that
Yeah,
further?
yeah, there's a lot of different programs out there. You really got to break the numbers down. There's Chinoa programs, there's Cal HFA, there's a Empower program out there, which is basically a grant. They give you 3.5% grant. It's not even a silent second. It's forgivable, but you always want to make sure you understand what the terms of those things are, and then what it looks like without it, what it looks like with it. When
Right, because you did
you look at it
mention
side
the
by side,
closing
you may be like,
costs.
my cash to close is only $2,000 less when I'm taking this program, and it's a half a point higher, and I'm only saving $2,000 when I look at it side by side with what your total cash to close is. Because a lot of times those programs will come with the origination points on the closing cost side. Now, if you're in a market where you can negotiate seller credit and that's available in your marketplace and you're short for cash, moving that money from down payment where you have to come up with the funds yourself to a closing cost where you can negotiate or get a seller to cover those costs can be beneficial to get into a house. But usually
Okay.
they come with some type of cost. Now, whether or not there were rumors that Cal FHA may come out with more funds for that 20% down program or do something different like that. We just don't know. When they came out with that program, they put $300 million into it. They thought it would last 6 or 8 months, and the money was gone in 9 days.
I heard about that. Yeah.
Yeah. I mean, it was a feeding frenzy, and people weren't ready or on the ball. It was to me, it was too much. 20% down, you could have helped so many more people get into a house if you would have just, we'll cover 3.5% down, we'll cover all your closing costs. That'll be
But put a cap on it,
30%, three or four times more people get into houses, you know?
right? Okay. It just sounds like for anything like that, anyone would have to be, like you said, ready and pre-approved and just ready to go. So,
Yeah, and that's something like that where they're giving you 20%. That just may never happen again, especially in
yeah.
California, where if you live in LA, a three-bedroom shack is almost $1 million. It's crazy. So you think anyone who bought a house down there with 20%, we're getting $200,000 a pop
It's crazy.
just in one
Yeah.
transaction. So it goes
All right.
fast with home prices like that.
Yeah. Okay. I'll let her know. And thank you for this. It's great tonight.
Yeah,
I was hoping some of my other friends and family could have joined, but I'm not sure if you're going to do this again.
yeah.
I guess you'll let us know.
I
You'll let us
recorded, so
know.
I recorded this, so I'm going to edit it and maybe chop out any parts where I stuttered. So there'll probably be a lot of minutes chopped out there, and then clean it up a little, and then I'll put it on my YouTube channel. But I'll email you guys all out a link to it. So if you
Yeah,
want to
that sounds great.
reference people to it, then they can reference to it. And I have a booklet here that accompanies this. It's a very in-depth book, but it's 30, 40 pages, but it goes into a lot of detail of each process. Maybe a
I
little
would
bit too much for
appreciate,
some
yeah,
people, but there's also budgets in there, budget worksheets and things like that,
I would
that
appreciate that. Yeah.
you can work out. And I'll shoot a copy of that out to everyone who's on here too.
All right. That sounds great. Thank you so much, Rob. This was great.
Yeah, awesome. Well, listen, and yeah, let's not do that, James. Thanks, bud. Yeah, I want to thank everyone for coming out. Listen, I'm going to shoot you guys out here tomorrow a link. I'd love to get like a 15-minute phone call, just very informal. Just kind of get some feedback from everyone, hear about what you're looking to do, see if we can put down some beginning stages of a game plan for everyone here to help you get to where you want to go. And they can always answer more specific questions. If you have a situation you're trying to work through or get past, maybe they'll offer some solutions there, get you to where you want to be. I thank everyone for coming out tonight, and I'll be in contact here this week. And listen, have a wonderful night, everyone. Thank you.